Welcome back to the Global Business Report on Horizon News. We're going to have a robust discussion on monetary and fiscal policy in Nigeria. Dr. Muda Yusuf, who is the Chief Executive Officer of the Center for the Promotion of Private Enterprise, says Nigeria may be losing its monetary policy focus because of elections. Well, he's calling for a reorientation of monetary policy and exchange rate policy, saying it's urgently needed in order to right the ship in Africa's largest economy. But the question is, if the entire economy is on the shoulders of monetary policy, well, what about fiscal policy? Well, he's here with us live. Joining us to discuss further, Dr. Muda Yusuf, Chief Executive Officer of the Center for the Promotion of Private Enterprise, also ex-Director General, Lagos Chamber of Commerce and Industry. You're very welcome, sir. Good to have you again.
Thank you.
Good morning. Let's get into it. All right. So the fiscal policy question, Dr. Yusuf, if all this focus on monetary policy, what about the fiscal side to turn the economy, the Nigerian economy?
The fiscal side doesn't seem to be doing much. You know, the focus has always been on just generating revenue.
Yes.
There is no much focus on how to even use the instruments of taxation to shape the course of economic activities. There is also no sufficient use of trade policy instruments, because the trade policy is also a component of fiscal policy.
Yes.
And unfortunately, for most part, the trade policy is also focused entirely or heavily on revenue generation.
Okay.
Because each time we engage the customs, for instance, it's just about giving revenue targets.
Yes.
Nobody is talking about trade facilitation. And there is no sufficient appreciation of the role of trade in the economic development process. Because when we talk about trade, it's not just all about importing. It's about importing and exporting.
Yes.
It's about also importing to strengthen the domestic capacity to export. It's about how we deal with issues of intermediate products for manufacturers, how we deal with issues of raw materials for manufacturers. So all of these things are critical. So in that sense, I think there's a lot more that should happen in the area of fiscal policy. Then also in taxation, we should also be able to be using tax to support some sectors, to give incentives, particularly to SMEs and things like that. We can do a lot more. So those are the things. Of course, monetary policy, a lot is happening, particularly around the development finance space. That is where a lot of activities. Of course, there are arguments or debates as to the quality of those interventions. You know, the issues of the rate of default and all of that, those issues are there. But certainly, I mean, the impact has also been positive. Particularly if you talk to industrialists and some high-end investors in agri or manufacturing. But for those in the SME space, they still have a lot of challenges, even with these intervention funds. Because interaction with them reveals that each time they try to access it, the issue of BG, that's bank guarantee, cross up. And once they get to that point, it's like a brick wall. Because not many of them have that capacity to provide bank guarantee. So there's still a major issue of access for the SMEs as far as this credit is concerned. And that is why if you look at the total credit to the economy and to the private sector, what goes to the SMEs is just maybe 1% or less.
It needs to be more.
Yes, it needs to be more, given the role that SMEs play
in the economy.
And it's also important that there is also that there is some collaboration or cooperation, coordination between monetary and fiscal policy. A lot of that has been said now and again. But it seems to be working, you know, in parallel. You know, the monetary policy is just focused on funding, whereas for you to also get the right kind of outcomes for the monetary policy intervention, you need some fiscal policy inputs. Because monetary policy cannot address the issue of infrastructure. It cannot address the issue of insecurity. It cannot address the issue of logistics and all of that. So all of these things need to work together. But unfortunately, we haven't seen much of that coordination. You know, so those are the things.
Okay, so we read your notes that you put out for the CCPE. With respect to infrastructure, I believe there's a there it is. So you're talking about the lack of focus being a profound implications for the confidence of investors, both for foreign and local. Central bank has to earn trust of stakeholders in the economy. Now, I want to show you there's a tweet here. Where is that tweet from the central bank governor on? So here's focus on robust monetary policy, fighting inflation, global issue, building a strong financial system in an increasingly uncertain global economy. That's from the central bank governor. Also, we're just looking at the Africa Finance Corporation. I want to talk to you since you mentioned infrastructure. Here is Andrew Ali, who is the partner at Southbridge Capital, talking about, I think he mentions InfraCorp. So let's take a listen to him.
Thing just to say, I think that is also important, and again is a little bit embodied in AFC, is that African money needs to be mobilized to solve African problems. The initial capital of AFC was essentially all African. You know, we found $1 billion on the continent and put into this thing. It was only once AFC got off the ground, then it started to raise funding from other people. But because we had that catalytic capital, we were able to raise that funding, and I see AFC has even done, you know, way beyond what we managed to do then, largely on our own terms. And that then gave us the flexibility to do other things. And so, so some of the initiatives that AFC is doing, also things like the InfraCorp initiative that Nigeria is doing, I think are very important.
All right. Now, prior to this, there was a tweet. Let's take a look at a tweet, I think, where guarantees were signed so that's from the central bank governor, said with the signing of term sheets. This is ahead of what was said with InfraCorp here, between the Infrastructure Corporation of Nigeria and the 4 infrastructure asset managers. Glad to announce that InfraCorp is now open for business. If we marry these two, can we say that the focus on infrastructure in Nigeria, as far as fiscal and monetary policy, is on its path?
Yes, of course. It's on the right path, only with these initiatives, because this is about bringing private capital into the space.
Yeah.
Because what we have seen over the years is just the budgetary funding of infrastructure. So the scope is now being expanded. So this initiative is a very good initiative. The AFC initiative is also a very good initiative. But the issue is, the infrastructure deficit
is large. Yeah.
I mean, by some estimates, we are talking about maybe close to $3 trillion, you know, that needs to be invested over 10 years or so. In other words, we need about maybe 100 billion US dollars annually in order for over 10 years to be able to fill the infrastructure deficit gap. So the gap is huge. This is a good initiative, but we need to do a lot more.
Okay.
Both from the budgetary point of view and also from this private sector point of view. Because the thing about private sector investment in infrastructure is that they can only invest in bankable infrastructures. You know? And we have quite a lot of infrastructure demands that are not bankable. That has to be funded by government.
Yeah.
I mean, we want to build a rural road, for instance. You want to build maybe schools for the poor. You want to build hospitals for the poor. The private investor will not put money there. They can only go for what is bankable, what is profitable. So we also need to define the limits of private investment in infrastructure so that we can have a good blend of both private capital and public capital. But we need to do a lot more because if you look at the structure of our budget, the percentage of funding that goes to infrastructure
is low.
It's very low. It's very low.
Okay.
You know, we are getting to a point now where even some of the borrowings we are going to get are going to use to be funding recurrent expenditure. You know?
Gotcha.
So that is it.
Yeah.
So we need to scale up. We need to restructure the budget. We need to restructure the government finances to be able to focus on areas in which the private sector cannot deal in. Then secondly, there is need for confidence of investors. Because the risk of investing in infrastructure is still extremely high.
Yeah.
We don't have a good history of very good performance in private sector financing or involvement in infrastructure. I mean, we have seen a few cases like Lekki and all of that. But many others have not worked well. And we had this bi-quarterly experience with Lagos-Ibadan Express.
Yep.
We had the MM2 experience, even though it's neither here nor there. So there have always been issues. Issues around the political risk, around the respect for sanctity of contracts, inconsistency of government policy, and all of that. So we need to de-risk the space in order to inspire that kind of confidence for investors to be able to put money. Because investing in infrastructure, private capital, is a very risky thing. And of course, in your previous discussion, you talk about perception.
Cost of capital.
And the cost of capital. Those things are there. So we need to address all of those issues if we must make an impact.
I want to quickly get, Dr. Yusuf, we never have enough time. We need an hour. We might need 1 hour with you. I only got a couple minutes left. Monetary policy. You said the monetary policy isn't going far enough. If you look at the last monetary policy, the accommodative stance of the central bank to allow for its interventions, as you've mentioned, to seep into the economy. Would you do anything different? Would you tighten the rates, the 11.5%? Would you loosen? Would you keep it where it is? What's your...
You see, as far as monetary policy is concerned, and if I take it along with the foreign exchange policy, the bigger issue that investors have in this economy has to do with the foreign exchange policy of the central bank. That is the bigger issue.
Okay.
Because of the impact on investors' confidence, the impact on the capacity to attract capital into this economy, the distortions that are being created around the differential in rates between the official window and the parallel market window, the fact that you have created a paradise for those who are round-tripping the currency, currency speculators, brokers in the foreign exchange market, all manner of issues around forex and liquidity. So it's a cross-cutting issue affecting practically all sectors.
Okay.
Whether you are talking of SMEs, whether you are talking of manufacturers, talking of aviation, it's a cross-cutting issue.
So how would you solve it? We have only that 30 seconds. How would you solve that?
The only way to solve it is to move to a market-driven exchange rate. Market reflective. I'm not talking of floating.
Okay.
Market-driven exchange rate, so that you can hear it's not market driven. If you have a market, you should be able to walk in and pick whatever you want. Can you walk into any window and pick $100, $100,000 now?
But the dependence.
How much of it will you get?
But what about the supply? The dependence on FX the supply of FX comes from oil.
It's not only oil. If you have a market-driven exchange rate, you have more liquidity in there and in window. You have more inflows into, so it's an ongoing debate. We have to discuss that especially.
Dr. Muda Yusuf, the head of the Center for Promotion of Public Enterprise. Thank you, Private Enterprise. Thank you so much for joining us.
Thank you very much. Thank you.